Are you ready to make the most of your oil and gas mineral rights? Welcome to the Mineral Rights Podcast. Get the knowledge and resources you need to manage your minerals and royalties. Here is your host, Matt Sands.
Hello and welcome to the Mineral Rights Podcast. I'm your host, Matt Sands, and I'm joined by my co-host, Justin Williams, and we're here to help you make the most of your minerals and royalties. And today we have listener questions for April of 2024, and we're going to go through a series of questions that really range, a pretty broad spectrum of owning oil and gas, minerals and royalties, and investing and learning. And so I'm excited to get into this, Justin, because there's some different questions that actually haven't been asked before and some nuance that we're going to talk about that I think will add some additional details to some of the topics that we've talked about in the past.
You said it, Matt. If minerals are anything, it's highly complex. And some of these really get into some interesting facets and some really great questions as to why it is the way it is.
Yeah, exactly. And so let's dive into the first one here. And so this is a really good one and a common question that I get. It seems like more and more lately around both people that are investing in minerals or wanting to invest in minerals and how to get started with that whole process. And so Tyler wrote in, he said, "Hey, Matt, you've mentioned in your podcast, although it may be only your older ones, a mineral rights basics course. How can we purchase that? I'm really enjoying learning about this subject, but still very much need to start from scratch in my learning. The podcasts are very helpful, but it leaves a lot of fundamental information holes for those who do not have experience in the industry." And he says, "Not a criticism. There's no way a podcast could fully teach it from the ground up. And I'm actually amazed at how much I've been able to learn from just the podcast. I'm also wondering, what is the best way to learn how to underwrite a deal? I know having someone partner with you, like you mentioned in several episodes, on a consulting basis for your first few deals is, of course, a great plan. But wondering, is there any education you would point toward to learn it, especially the technical side, and how to analyze well quality itself?" He says, "I'm a finance guy, by the way, no technical knowledge. I'm also very interested in learning how to analyze operators and their drilling plans, but figure I should learn the technical side first. Keep up the good work. I find it very valuable, and I'm sure many, many others do too. Thank you, Tyler." So Justin, you want to take a shot at answering some of the questions he had there, and then I'll chime in as well.
Absolutely, ma'am. So thanks, Tyler, for your email. And we appreciate that you found the podcast to be really valuable to you. For the course, you can go to mineralrightspodcast.com/courses to find Matt's Mineral Management Basics course, which goes more in depth into the knowledge you should have as a mineral owner and investor. And that's for the differences between types of oil and gas interests, performing a title search, important documents and how to organize them, reading a legal description, finding your interest on a state oil and gas website, and seeing how you should be getting paid royalties. And Matt, one of the really interesting things about minerals is there's so many really complex aspects. And so Tyler's more referring to the technical side, which, Matt, you have an education in on how to analyze a well. And that's a whole different world of complexity than the ownership side. And the course covers a lot of the material that Matt uses with his coaching clients who are new to investing in mineral rights and royalties. And it really sets that foundation of things you need to understand in order to perform the due diligence on an investment, title, who owns it, and how much potential is there, that kind of thing. And Matt, do you want to talk a little bit about underwriting a deal? Because that's where I think my knowledge definitely has a gap. As an investor, that's a whole different aspect that you kind of bring on. And it's something that really has to be a case-by-case basis, especially for the forecasting production. And I know you use special software, Matt, and you have that very specific information and education on how to interpret that data. Because even if I went looking, it'd mean nothing to me.
No, that's a good point. The first thing I'll say is that the Mineral Management Basics course does cover what I would consider to be the base level of due diligence that you would do when underwriting a deal. So it's collecting the information you need in order to understand what you're looking at. So for example, somebody says, "I'm receiving royalties. I'd like to sell my interests. Would you be interested in making me an offer?" Well, you'd have to do a little bit of research and go to the county clerk and recorder's website, pull their mineral deed, look at the oil and gas lease to see what their lease terms are, what the lease royalty rate is, and those types of things. And so that's like a fundamental thing that you would need to do for any deal. And then ultimately, if you do end up getting under contract and going through the process of purchasing those interests, you would need to run title from patent to present. In other words, back to when that land was originally homesteaded. And when that was first given from the US government to a private individual, and then trace that ownership back over time to understand what the seller actually owns. And so that's something that we do teach in the Mineral Management Basics course. Again, that is a critical skill. Now, as far as the technical details, now it's really understanding, okay, how much is this person receiving in royalties? So I think the first step is to obtain copies of royalty statements to understand what their decimal interest is in the wells they're getting paid on, so that you can confirm their net interest based on your independent search and just kind of use that to verify what you find as a starting point potentially, before you go and run title in case you don't know. And so that's a key step. And then performing a decline curve analysis on a well is really not that hard. It's kind of a visual exercise. Now, you do have to know in the back of your mind some of the boundary conditions on the parameters you use in that actual process. So when that equation pops out that says, here's how the well is going to be producing in the future, you have to understand, well, okay, there's different stages of production, and that may look like different things according to the different basins that you're looking at and that kind of a thing. And one way to actually go and find out how operators are looking at it, and keep in mind that this is going to be an optimistic view of how they see things. So you'd probably want to come up with your own analysis of that, and probably a more conservative approach, especially if you're investing your money into a deal. But there's two places you can go for that. First is in pooling and spacing orders with the State Oil and Gas Commission. If the state that you're looking to invest in, that is something that is done, if there's statutory pooling, in other words. So Oklahoma, for example, Colorado are two examples of where there's statutory pooling. Ohio, another one. And so you can go in there, and in those filings that those operators file with the state agency, they have reserves estimates. They'll have sometimes a type curve, and that'll show you the decline curve parameters, which there's things like the B value, the initial decline rate, terminal decline rate. And those are things that you can plug into the software that you're using to come up with, what that cash flow projection is going to look like for that investment. And so, this gets into a bunch of details. We can go and cover this in a whole episode, and we probably should here in a future episode just walk through the process. But as far as tools go, I think this is one thing where getting some education, if you don't have an oil and gas background, taking a course in an intro to reservoir engineering course for like non-technical people is a good idea. There's you can just Google that, and there's technical schools out there. I'll try to think through some of the courses I took when I was in the corporate side of things and post some links in the show notes to this episode, just to have some resources out there for people wanting to go a little bit deeper on the technical side of things. There are also some tools out there, a couple that come to mind. And the thing is this gets into like, you want to be like pretty serious about doing this, because unfortunately the oil and gas software that I use, PhD Win, is a great one that's pretty powerful, kind of technical in nature. So you kind of have to learn how to use the software. It's not super intuitive, but then there's some other web-based applications out there that others are building that can be a good way to go. But those are very expensive. Typically those software packages are like in the tens of thousands of dollars, either to purchase it outright or a subscription-based service that is fairly pricey. Partnering with somebody that has that software is a good way to go, because then you don't have to foot the bill for that. You can kind of leverage their expertise as well, have them teach you and show you how they underwrote the deal. And to your point, finding a coach or finding somebody that can do that one-on-one consulting to help explain that thought process can be invaluable and a good investment as well. I do that for several of my clients who are investors and kind of new to that side of things. And I've worked with a few, and my goal is to teach people, here's kind of how I look at things and how I go about it, and then hopefully work myself out of a job. In other words, teach you enough that you can go and do this on your own. But, always be there as that resource for folks. So yeah, ultimately underwriting each deal it's like Justin said, it needs to be done on a case-by-case basis. It really depends on the asset you're looking at, whether it's fully developed and it's just got producing wells, in which case you potentially could use a multiple of cash flow if those wells are fairly old and pretty slow decline. But you might be able to do that. More than likely, you'd need to do a decline curve analysis on those wells to figure out what they're going to produce into the future, how long they're going to keep producing for. And then if there's new wells that are permitted or whatever, then building type curves and forecasting the cash flow from those new wells and then putting that all together to figure out what that's worth in today's dollars. And that's how you come up with the purchase price. So yeah, hopefully that is helpful in just understanding the thought process. Obviously, it's more technical and more in depth than we can cover in a quick Q&A, but I'll definitely put together a future episode and go into a little bit more detail on how that's done. So yeah, feel free to reach out if you have any other questions or if you'd like to work together. So thanks again.
Thanks, Tyler. Great question. So our next one here, Matt, is from Margaret Ann, and she's asking what needs to be retained. And we assume that she's talking about documents here relating to each well or each property. What exactly needed to be retained is that the year-end statement from each operator, and then what's to be gained by this data. And Matt, this is something we talk about a lot, and it is a lot of information to try to store. Some of it is on a yearly basis that we're storing it, and then some of it is on a per property, and then some per well even perhaps. And I think the most important thing, Matt, is the documents related to taxable income. When it comes to the 1099s from the operator, any of the royalty stubs, the rule of thumb for pretty much anything financial is to hold on the documents for at least 7 years. After the 7-year mark, it's kind of different for the IRS and the limit that they have to audit you. So if you wanted to keep them for personal reference longer than that, you certainly could. And then, Matt, there's other documents like division orders, correspondence related to oil and gas leases that talk about bonus payments, what your net acres are. And then there's the title work, the deeds, again, the division orders, the copies of the leases, and really those need to be kept as long as they're active. And Matt, I think this kind of goes back again to if you don't have that foundation of mineral management, it makes it a lot harder to understand what to keep. So it's great advice to kind of get a hold of that. And I think it becomes a lot more clear what's important and why.
Yeah, I think you hit the nail on the head as far as the things that people should think about for those oil and gas revenue check details that Margaret Ann was asking about. And as far as what's to be gained by the data, it really just depends on if there's wanting to keep record of certain things that happened maybe right after that well started producing and what did that production look like. Now, keep in mind that all of the state oil and gas commission websites have this information available online now. So, from the history standpoint, there's less of a need today than maybe there was, before the internet and before this information was available at your fingertips with the computer. It did make maybe more sense to keep those for a longer period of time. But like Justin said, keep them for 7 years. And then unless there's a real strong need, then I would just shred it and make sure that you check with your CPA to get specific tax advice. We aren't accountants or CPAs, so don't take this as legal or tax advice. It's just for informational purposes only. So definitely check with your CPA and get their take, because there may be other reasons that you might want to keep that information that we're not mentioning here today. But again, this is another reason to think about taking mineral management basics, because I do go through the important documents and then what you should keep and for how long. And so I think there's a good amount of information that you do need to keep for the life of the wells or the life of the property as long as you own it. But then for the financial stuff, you don't really need to keep that beyond 7 years typically. So hope that helps. Thanks.
Absolutely. And Margaret Ann mentions too, something about scanning the documents, which can really get out of hand and just not be feasible. And Matt, like you mentioned, a lot of it's available online now. And I know I typically try to save everything digital first, which does take a lot of the headache out of being able to retain those documents and those emails. You can save an email as a PDF and add it to that folder. All right, Matt. So our next one here is from Nate. And this is an interesting one. So Nate says, "Hi there. I just discovered your podcast recently and I'm impressed on all the aspects of oil and gas investing you've covered in the past 5 years." That's crazy, Matt, to hear the 5 years. "I'm in a situation that will eventually be earning the right to participate in a non-op in units being permitted in Utica. I know there's a robust secondary market for people wanting to sell some or all of their non-op positions in AFEs. Could you dive into what a typical deal would look like from a seller's perspective, such as what is the range of price per acre that seems to be paid, royalty reservations, etc.? And Matt, this is an interesting one. We don't talk to a ton of mineral right owners that have non-op working positions.
Yeah, typically people decide to lease, and so they don't end up getting the option to participate. But yeah, if you get force pulled and decide that you didn't want to sign a lease, you do have the right to participate. And that would mean paying your proportional share of the cost to drill and complete those wells. And then you would be a non-operated working interest owner. And there's lots of pros and cons. The pros, can be huge in terms of the tax benefits you get with that. And obviously there's a lot of risks that go with it. So you definitely need to consider both of those. And we talk about that in a couple different episodes. The first one is episode 7, which is working interest for mineral owners. And then episode 126, a deep dive on investing in mineral rights, royalties, and working interests. So definitely check those episodes out if you haven't already. And as far as the secondary market, so the value of each non-op working interest and like the AFE opportunity varies from deal to deal. And I don't know that I could give you a typical price per acre that would apply per se. Within one operator with one area, you could probably land on that. But, operators' costs look different, both their cost to drill and complete a well, as well as their operations costs. When you get that AFE, it'll have a specific dollar amount, and that may vary slightly from operator to operator based on the methods that they're using, their overhead, and those types of things. So that can affect the value. And then I would consider, if you are looking at participating or even selling that before you participate, so that opportunity, a lot of times investors will look at that because they want the intangible drilling cost deduction. So you can expense those intangible drilling costs in the year that you have that expense. And so it can be a big tax benefit. And so people will look for those types of opportunities to invest under a good operator. Now, I will say holistically, things that will affect the value, Nate, are which operator the permits are under, the AFEs are under. If it's a really good operator, that'll have more value. If it's a operator that tends to not fulfill their promises as often as others, in terms of they overspend the AFE or they don't drill as soon as they say they will, those are the types of things that, or maybe they treat their non-operated working interest partners poorly in terms of not providing access to information, overbilling them, or adding more overhead to the joint interest billing statements and stuff like that relative to some of the other operators in the area. Those are the types of things you'd have to keep in mind. If you do look at selling a leasehold position, because effectively that's what you're talking about, whether, again, we don't know his particular situation, whether he has a mineral position that he's participating in or if he has a leasehold interest. But, from a leasehold interest point of view, it's pretty common to take a overriding royalty. So if you sell your working interest, you could retain an override in that lease and then not have the expense side of things, but then you get some of the upside from the royalty reservation that you make. So that's what he's referring to with that. So that is a good deal. And it really just depends on who you're selling it to and what they're going to be willing to negotiate. So all of those things I think are on the table, again, depending on what type of interest it is and that kind of a thing. So yeah, hopefully that helps. And again, unfortunately, I can't give you like a particular price per acre to negotiate for. I think it really would make sense to hire a professional to get an evaluation of your interest to understand what the value is before you negotiate that. And then as far as going to find buyers for those working interest positions, I think EnergyNet is a good spot for that. Or there's other brokers probably that deal in the Marcellus and the Utica that you could talk to that would be interested. So hope that helps.
So our next one here is from Gene. Gene says, I'm a mineral rights owner. My family has over 80 acres of mineral rights in the Haynesville Reservoir, the state of Louisiana. I need help understanding what does it mean and how to investigate the situation. If you can provide any assistance or point me in the direction where I can solicit assistance, it'd greatly be appreciated. And Matt, this is just such a common question, either from somebody who just inherited it or just realized that they owned it. Maybe an operator reached out to them. But where to start, Matt?
Yeah, I think episode 90, where we covered the overview of the Haynesville Shale, is a great place to start. The thing to know about the Haynesville is it's a gas play. So right now it is something where we're seeing pretty depressed gas prices below $2. And so that is something to keep in mind in terms of the future royalties and those kinds of things. The Haynesville has wells that'll produce a lot of gas, which is really good. But yeah, it just depends on your situation. If your 80 acres are leased, held by production by some wells, and if there's room for additional wells, then you could expect to see more royalties in the future. But I would say, because it's all purely a gas play, it may be a while. We may not see more activity until gas prices recover. So that's something to think about. And then one thing I'll mention, Gene, because we talk about more about the Haynesville in that episode, but just in terms of your family owning the 80 acres in the state of Louisiana, keep in mind that if those are non-producing, Louisiana does have a dormant mineral statute. You have to do some certain things to protect those rights. Otherwise, they will revert to the surface owner. So be sure to do some research there and hire an attorney if you need some help, around that to protect those rights. So good luck.
Thanks, Gene. All right, Matt. Our next one here, I have never heard of this, and it's a very interesting question. So this comes from Robert, who says he's listening to the podcast from Sweden, which thanks, Robert. He says, my lawyer was going to file a petition to appoint me personal representative and successor trustee for my late aunt's estate, where my uncle has 40 acres of mineral rights. However, he had just heard of the Oklahoma Senate Bill 212 that, from what he's been researching, it looks like as a non-resident alien, he might not be able to register any deeds in Oklahoma, which is what would need to happen to shift title from the estate to himself and the other beneficiaries. So, Matt, that really makes a kind of a tricky situation in Oklahoma because, per se, maybe owning that property is not against the law. If it's against the law to file a deed to transfer that ownership, that could really get interesting. And Matt, you know better, but isn't Oklahoma also a dormant mineral state?
I don't think it is, but I will say that this was news to me. I didn't realize that this was on the books. And since then, it's kind of come up a couple of times. But he mentions that he would not be able to register a deed for the shift away from his uncle to his aunt's estate to him or whatever. So the minerals can't be sold, which you have to be able to record a deed in Oklahoma in order to sell the interest. So it's kind of a catch-22 that he finds himself in. And he says, strangely, there's no law preventing the ownership per se, but filing a deed is impossible. He says, do you have any news if there are any amendments inside or possible workarounds? And so, yeah, it looks like the requirement had been in place, and that Senate Bill 212 amends Section 121 of the state statutes, which relates to alien ownership of land. And it's, for those of you that may be not familiar with this, I did a little bit of research, and the amended text in that bill says the subsection shall not apply to a business entity that is engaged in regulated interstate commerce in accordance with federal law. And so basically it's a state specific thing, but if you're governed by federal law, it wouldn't apply to you. So the question I had to him and our back and forth was if he owned minerals in other states and if owning minerals in multiple states might qualify as interstate commerce, and if you had an LLC or things like that. And so again, the big takeaway here is for him to talk to his attorney to see what they can do. But yeah, I mean, this is interesting. I can see what the intent was. I think the intent of this law was to prevent foreign governments or whatever from coming in and purchasing real estate in that state. So, for example, China buying up a bunch of farmland and owning that. And then there's like that national security risk. I don't think it was intended to prevent people that are heirs to land. In other words, maybe they're non-resident alien. So basically somebody that used to live in the United States or maybe had relatives that moved out of the country and then they were born in another country, but then their roots trace back to Oklahoma or, somewhere in the US. And to be able to inherit that property, again, you have to be able to file a deed. And so Robert mentioned in a follow-up email that he said that it looks now as though my lawyer will be able to sell the 40 net acres in McLean County within the Oklahoma probate, and then the proceeds can be distributed by me as successor trustee. So that is the workaround there. It sounds like they were able to sell it within the probate. So the estate basically is selling those interests, and then the proceeds will be distributed to the non-resident alien heirs that live in Sweden or wherever, like Robert. So I guess it's good that he's able to capitalize on that and get the economic benefit. I think the downside to this particular law in Oklahoma is that it prevents those people that are descendants of those that had homesteaded or that had property in that state from inheriting that property and wanting to keep it. So it forces the family to have to sell the interest in order to distribute the asset. In this case, they have to monetize it in order to distribute it to the heirs if any of those live in a different country. So I guess if you had some relatives that lived in the US, you could, work something out internally within the family. But yeah, it's kind of an interesting conundrum that people find themselves in if they're affected by this law.
Yeah, you said it, Matt. It would be interesting to know if there's other states, which I'm sure they do, that have laws similar to this. But yeah, it makes kind of a catch-22 in an interesting situation. And Matt, our next one here is from Anna Blair. She's asking, how can you determine if the amount of paid royalties is accurate? They sold the land, we're assuming the surface rights, but kept the minerals and leases, and they've been traded around by different entities. We were in a party with about 10 other people, and now all the leases aren't even being listed on the payout sheet. Just got the tax notice and the taxes are higher than the amount we received from the gas leases. Also, why are we paying taxes on the gas leases when the landowner is paying on the same property? And so, Matt, there's a few fundamental or foundation to say here. So, Anna, if you're wanting to make sure the operator is paying correct volumes and appropriate market prices, that's something we covered in the Mineral Right Podcast, episode 97, how to audit your oil and gas royalty statements. And then in terms of making sure your decimal interest is correct, assuming you know how many net mineral acres you own and your lease royalty rate, you can calculate your decimal interest in those wells by following the steps in Mineral Rights Podcast, episode 3, which we cover how to calculate your net revenue interest in 3 steps. So, Matt, the question gets a little bit more complicated, and she mentions the payout sheet, and maybe she's referring to the division order. But, Matt, that's not something where you typically see the ownership of other people. So the question becomes, what was that party of 10? Perhaps it was just all the different people who executed leases.
Yeah, and it depends on the operator because I have seen it both ways. I've seen some division orders where they list everybody with an interest in that well. Even though maybe that's 20 or 30 people or 100 people or whatever, it's just this long list of people. Typically, you don't see that. It's just for your particular interest. So, and probably what happened is the ownership switched from an operator that the practice was to send the division order with a list of all of the people that were mineral interest owners or working interest owners in that well. And then it transferred to an operator that they didn't do that. And there's not a law that requires them to send that information out. And typically they don't, just because I think it's more beneficial for them the less information they provide, just because there's some confidentiality issues with that. Or maybe if something is wrong, then, they don't want to arm their mineral interest owners with more information to come after the operator. So, it's something where depending on the state that your interests are located, now from the tax standpoint, I'm surprised that the taxes are higher than the amount that you received on leases. So there's sort of 2 ways that minerals or royalties can be taxed. In Texas, for example, you get taxed on the royalties that you receive. So by definition, I would expect that to be less than the amount from what you're talking about. Maybe it's ad valorem taxes, so where you'll pay property tax, and that can be on both non-producing and producing minerals. On states like Colorado, for example, that is the case where you'll receive a property tax bill even if you're not receiving royalties, or if you're receiving a very low amount, that property tax bill is going to be the same year after year. And so it could be that you just happen to receive less than that. And usually it's a pretty small amount. It's, like less than $100, depending on the size of the interest. But I will say that if you are getting a tax notice and it has anything to do with the surface rights, then it's possible that the tax assessor has not correctly updated their records and they are sending you an erroneous tax bill. So usually when you get a tax bill, there is the opportunity to protest. They'll do an evaluation of your interest. And so they have the appraisal that the tax assessor did. And you can protest that and provide documentation to try to get that back down to what you believe is a more fair value. And so if that is the case, I would maybe recommend taking a look at that process within the county where you own those interests and maybe go through that process of protesting that. And, sometimes they get it wrong as far as those property tax bills. So it's possible that it's just an incorrect thing since it sounds like you sold the land recently. That's oftentimes where I've seen issues where they are still sending the property tax bill to the old owner and, maybe they haven't split that up in their records. And so, scrutinize that tax bill very closely to make sure that you're getting taxed correctly. And again, your last question, why are you paying taxes on the gas leases when the landowner is paying on the same property? Well, because you severed the mineral estate from the surface estate. If it's in a location where they still tax those 2 separately, you will just receive a tax bill for the mineral interest portion of that. So it sounds like that's the case where you own those minerals. So hopefully that helps.
Thanks, Anna. So our next one here, Matt, is from Alan. And Alan brings up a great point. So Alan says he enjoyed the session on late royalty payments. Just one thing that he thought we missed on resetting the minimal threshold for royalty payments to be paid. He goes on to say that I think the most important reason to reset the minimal is not to get the small amount of money, but it's to establish and continue contact between both the royalty owner and the company paying the royalty. I know there have been wells in the past that were forgotten because there was no regular communication via royalty check. Even a year is too long in some situations. Some companies will not even pay on an annual basis if the amount is below $10. Just something to consider that might help others. And Matt, that's a great point to bring up. And each state may have varying payment thresholds where they require any funds that were accumulated to be paid. And then the operator sometimes will set a threshold either below that or above that, or they'll follow the state threshold. But Matt, this is something that can be negotiated and you can communicate with the operator about to kind of have a preference in this.
Yeah, usually that is when you receive a division order, it'll outline the minimum payment threshold. And usually the operators will try to establish a value that is higher, as high as possible for them, just so that they don't have to issue checks as frequently, because there is an expense for cutting a check and the whole accounting side of things. And so if you have a very small interest, the fewer times they have to issue that check, it's more beneficial to them. Now, to Justin's point, if there's a state statute that says it should be a certain amount within every year, and like Oklahoma, for example, we talked about this in episode 224, which is what to do about late royalty payments. And we talked specifically about Oklahoma and the minimum payment threshold there. And in that situation, Oklahoma has some of the most robust state statutes around paying royalty owners. In other words, they have that $10 minimum within every year. So basically, if they've accrued at least $10, but less than 100, then basically the operator has to pay you annually. Then there's some other like very specific thresholds between 25 and 100, and those types of things as to in terms of the frequency they have to pay you, and whether it's monthly payments or whatever. So again, that's where the division order comes in. If you have a very small interest in a well, or if the well is producing a very small amount of oil and gas, then it's beneficial, to Alan's point, to establish as low a payment threshold as possible so that you get more frequent royalty checks. And like you mentioned, we talked about it in the context of making sure that the operator wasn't holding on to that money and you're not getting paid interest during that time period. You might as well get it in your bank account, deposit it in your savings account or whatever, and earn a little bit of interest on it. So, but from his standpoint, it is a good point to continue contact, make sure that they're issuing checks regularly. That keeps you in the loop. If it's a medium size or larger operator, they're going to have a robust accounting system that'll issue those checks, based on the payment thresholds in their accounting system. If it's a very small operator, I can see how, like you mentioned, that it could get forgotten, so to speak, if it's a manual process that they have to go through and look at, okay, where do these people meet the minimums and that kind of a thing. So certainly a good idea. And he does add on, he says, FYI, we have an interest in about 120 wells in Arkansas and Louisiana, get payments on some each month, some once or twice a year, some no payments for a long time, even though producing, and some not producing, but held by production of other wells. In some cases, interest has so many zeros after the decimal that rounding keeps payment below zero. He said, working through your mineral management basics course, but slow in getting it completed. And he's saying, thanks for your efforts to educate folks. I'm trying to educate one individual currently signed a lease that has 160 gross acres, trying to convince him that his net mineral acre figure is only about 0.3 acres. Got a long way to go. So thanks for writing in, Alan. And that you bring up a good point as to maybe why you'd want to establish a low payment threshold if you can. So thanks for that feedback.
Thanks, Al. Well, that takes care of the listener questions for this time, Matt. And again, there were some really great questions on some complex aspects of owning mineral rights.
Absolutely. So again, you can find links to the episodes we mentioned in the show notes at mineralrightspodcast.com, and we'll list all of the questions there as well. And so thanks again for listening. And if you have a question you'd like us to answer, send it to feedback@mineralrightspodcast.com. Thanks.
Thanks so much for listening to the Mineral Rights Podcast with your host, Matt Sands. Don't forget to subscribe and share at mineralrightspodcast.com. The Mineral Rights Podcast should not be construed as investment, legal, or tax advice. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy.